Good day, my name's Ed McFerran. I'm House Counsel for Tax Deferred Exchange Services. We're headquartered out of the Western Washington area, and we provide qualified intermediary services throughout the United States. This is a video to discuss matters of partnerships and limited liability companies as regards tax deferred exchanges. In our practice of providing what's called qualified intermediary services for tax deferred exchanges, the question comes up on many occasions of who is actually the exchangor. The term exchangor, of course, is a term that we use for the party that's completing the tax deferred exchange. Of course, if it's Mr. and Mrs. Smith that are completing the tax deferred exchange, we would say that the marital couple is the exchangor. If we have an individual providing those services, it would be that individual would be the exchangor. When we have a limited liability company, when we have a corporation, when we have partnerships completing tax deferred exchanges, it's a different analysis because the partnership is the exchangor, or the limited liability company, or the corporation is the exchangor, not individual members, not individual shareholders, not individual partners, but the whole entity or partnership would be deemed to be the exchangor. In our practice of completing tax deferred exchanges, there is no difficulty when we have a partnership completing a tax deferred exchange. There's no difficulty for a corporation completing a tax deferred exchange. No difficulty for a trust. No difficulty for a limited liability company, because each one of those are regarded separate tax identification number parties. What I mean by that is if a partnership is completing a tax deferred exchange, that partnership will have a specific, what we call TIN, tax identification number. This is the number that is analogous to the Social Security number that each of us have individually, and is the tax identification number for a partnership or a limited liability company or a corporation for that matter. They all have individual tax identification numbers with our friends at the Internal Revenue Service. That tax identification number produces an individual exchangor number that must be the same at the relinquish stage or the sale stage as it is at the replacement stage or the acquisition stage of a tax deferred exchange. In essence, we need to have the same exact exchangor exchanging out of property as we have the exchangor exchanging into another replacement property. This is really important. So if an individual is completing a tax deferred exchange, that exchangor would have the Social Security number. If it's an entity, an LLC, a corporation, or a partnership completing a tax deferred exchange, they will have a separate tax identification number. All of this is great background, and possibly this is some of the information that you already know, but the reason I suspect that you're listening to this video is you're not planning on completing an LLC exchange, or not planning on completing a corporation exchange, or even a partnership exchange. The reason that you're getting this video is that you are a member of an LLC, or a partner in a partnership, or possibly a shareholder in a corporation, and it's a small corporation or a small LLC with a limited number of members or shareholders or owners or partners, whatever term happens to be attendant to that particular type of venture. One member or two members or three members want to complete a tax deferred exchange, and other members or partners or shareholders want to complete a sale. The difficulty, of course, is that in order to complete a tax deferred exchange, we must have the same entity completing the relinquished property, as I said before, as acquiring the replacement property. The difficulty in tax deferred exchanges is that we must exchange real estate for other real estate. Going back to basic principles of law, a shareholder interest in a corporation is deemed to be personal property. A membership interest in an LLC is also deemed to be personal property, and a partnership interest in a partnership is also personal property. Therefore, a partner cannot exchange a personal property interest in a partnership for a real estate interest in real estate, because that would be an unlike-kind exchange. This is a difficulty, and it's a difficulty that's presented in many occasions in our practice where clients come to us seeking help and assistance in order to change or modify those particular types of entities into another type of form of relationship. We can accomplish that. We do like to accomplish these types of things well before the tax-deferred exchange closes, well before you list, or well before you enter into any type of agreements, but in many occasions those types of situations are not available. However, today we will talk about a couple different methods of completing an exchange, where in one case, probably the best method is to actually modify the type of arrangement into another arrangement that will be more acceptable. Let's assume for just a moment that we have a partnership that consists of 4 different partners. In essence, it could be an LLC that has 4 different members. Also, in essence, it could be a corporation that has 4 different shareholders. It really doesn't matter what type of organization we're talking about. It just matters that we have certain parties, whether members or partners or shareholders in the organization, that want to complete a tax-deferred exchange, and other parties that may not. In our case of 4 different parties, let's assume that 2 of the parties want to complete a tax-deferred exchange, not necessarily together. Let's assume that 2 of the parties would rather just sell their interest in the property, pay the tax, and walk away. The difficulty is if we can't have the corporation or the limited liability company or the partnership accomplish that as an entity, we have to break that entity apart and change it and modify it in order to produce a more acceptable arrangement to complete a tax-deferred exchange and a sale. Our best practice is to terminate the partnership, or in turn terminate the LLC or the corporation, and distribute the property in like fashion to the membership or shareholder interest or partnership interest, to the individual shareholders, partners, or owners, and have the property that is owned by the entity conveyed individually to each member or partner. In our example, we would terminate the partnership arrangement. We would file a last tax return for that partnership arrangement. We would convey by deed through the partnership to the individual owners of the property. And let's make it simple. Let's assume they're each a 25% owner of the property. And at the end of the day, the property, the investment property that we're selling, would be owned by 4 parties, each having an undivided 25% interest in fee title. This is important because they're going to actually own a fee title interest in the property. And they're going to change their relationship from partnership or LLC into what we call a tenancy in common relationship. You may have heard the term TIC, tenancy in common. As a result, the previous entity who filed tax returns would no longer file tax returns. The new ownership group, tenants in common, which each file their own information on their own tax return on Schedule E, as opposed to having the partnership tax return and the K-1 distributions. At the end of the day, there would be no tax consequences for modifying the relationship from a partnership or an LLC to a tenancy in common, except we would highly recommend, under a special revenue procedure, that the parties execute a tenancy in common agreement that coincides with the requirements of the Internal Revenue Service to be deemed a tenant in common and not to be deemed a partnership. This would be our best practice, a method of accomplishing that. This is something that we do as attorneys for clients on an ongoing basis, and we'd be happy to accomplish that for you in conjunction with the planning for your tax-deferred exchange. A second strategy is what we call swap and drop. This is a transaction in which we keep the entity alive and complete the overall tax-deferred exchange, and the partner or shareholder or member that wishes to leave the partnership or LLC or corporation then does so at the end of the exchange, and they have their ownership interest distributed to them at the end of the tax-deferred exchange, and the entity continues on, but it only has 1 or 2 members. Another strategy is what we call the drop and swap, and this is a method whereby one of the members or partners actually drops out of the entity, and then the entity continues on and does the exchange afterwards. All three methods are somewhat beyond the scope of a very detailed video, such as what we have here, and would require the expertise of speaking with one of our staff members to see how your situation would fit in to this type of method of creating separate ownership interests and tenancies in common in order to accomplish the goal of doing both a tax-deferred exchange for some parties and a sale for other parties. Again, if a LLC or a partnership or a corporation or a trust wishes to complete a tax-deferred exchange, it can do so. It is when we start separating out the trust or the corporation or the LLC or the partnership that we need to huddle together and strategically take a look at what we are doing and when we're doing it. We highly suggest that these types of actions that we depict in this particular video be taken well before listing the property for sale, well before receiving a purchase and sale agreement on the property, and certainly not on the evening before the closing of the transaction. We often say that time solves all wounds in tax-deferred exchanges, and we like to have a good time period between changing the structure of the ownership and actually entering into sales. So this is a good planning opportunity. We would love to see 1 or 2 years before the transaction occurs where we make these changes, but we still complete transactions where these changes occur literally prior to the time of closing. Again, this is a very general video. It gives an overview and does not replace the advice and counsel of our staff. We're available daily to take your calls. We provide qualified intermediary services throughout the United States. Our home office is in Tacoma, Western Washington, and we're happy to assist you in your more complicated tax-deferred exchanges. Good day.